I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, thanks for having me.
And Tim, I know you live in the southeastern corner of the U.S., lucky enough to be missed by Irma and Harvey?
Oh, yeah. It was a non-event where I'm at.
Well, lucky you. So where are you exactly? I'm curious.
I am on the Alabama Gulf Coast. Right on the coast near Pensacola, between Pensacola and Mobile.
Yeah, so, you did dodge a bullet.
Yeah. This area is no stranger to hurricanes. I guess it's just luck of the draw where they go. But no, we missed this one.
Tim, what's happening in the commodity, especially metals market?
Jim, I wanted to walk through that today because there's an awful lot of interest with the rally in gold, and I understand it. I do, and I want to explain it or try to. And so let's walk through things. I don't want to be redundant here, but I want to make a point, and then I'll tie it together toward the end. While I was waiting on you to call for the interview, I printed a bunch of charts and went over some stuff to get it in front of me, and I just kind of want to walk through these. And starting with aluminum, I want to go through all the metals and then tie it to the commodity complex to make this point. But starting with aluminum, we had the kind of the little double bottom, if you will, 99, 2001 bottom, which was a 9-year bottom. And then aluminum went up into July of 08, just like gold did, down into early 2009, just like gold did, up into 2011, just like gold did with that 9-year cycle top. In that case, it peaked in May. Gold was September. As I recall, I'm saying that from fuzzy memory. I'm not looking at the gold chart at the moment. And then down into the most recent low in November of 2015. So the rhythm with aluminum is exactly the same as that we're seeing with the precious metals. And again, not to be redundant, but you look at copper, you got the 99, 2001 low, you got a top in the 9-year top in July of 2008, you got a low in December of 2008 when all the commodities crashed. And then you've got the February 2011 high again versus the September high in gold. We got a January 16 low, and here we are. It's bounced. Lead, without being redundant, it's the same pattern. And you go through the next chart, nickel, it's the same pattern. You go through the next chart, tin, it's the same pattern. Zinc, the same pattern. And I realize it's not sexy to think of your gold as having the same cyclical pattern as lead, but in reality, it does. And the risk here has been that every 9-year cycle, since gold has been freely traded, and you can see in these other metals that there's also that 9-year cycle pattern. There's been 9 of these little annual cycles embedded within the 9-year cycle with every single 9-year cycle. Every single one. And all the metals have the same pattern. And these other metals, the structure, some of them are more positive than others, but when I say positive, I'm saying intermediate term positive, not longer term positive. But they all have the same basic structure. And there's been some talk recently, well, gold has made some right translated advances, intermediate term advances since it's come out of the 2015-16 low. Yes. That's a December 15 low. Yes, that's correct. It has. But we still have the higher degree over lying umbrella, if you will, of this 9-year cycle phenomena. And like I said, there's been 9 cycles down within every one of these cycles. Well, at the 2015 low, again, we had only seen 7. So it's problematic to say that you've seen the 9-year cycle low under these conditions with only 7 cycles down. Now, I understand everybody's excited about the rally, and admittedly, it's been a little stronger than I thought, but it hasn't changed anything yet with the structure, and we certainly haven't negated that higher degree statistic with the 9-year cycle. Now, let's go to, well, let me make another point. If you look at the XAU, which is a basket of metal stocks, it's got the same pattern. You know, a bottom in this case in October of 2000, a high in March of 2008, and the low in October of 2008. The 9-year cycle top in this case, it topped ahead of gold in December of 10. And guess what? It's got the low in January of 16, identical same pattern. But so far the advance here with the gold stocks, the high was in August of 16, a year ago. Well, why are the gold stocks not leading this if it's such a breakout? I feel like that is a warning. But then there's a little bit more to this. When you tie it to the CRB index, and again, I know people don't want to think of gold as money. As a commodity. They think of it as money. I get that argument. I'm not negating that argument, but the facts are it tracks to these other metals, to lead and aluminum and copper and the CRB index. And so I'm not trash talking gold. I'm telling you what the patterns are. And so if you look at the pattern in the CRB, there's a dominant 3-year cycle, and there was a 3-year cycle low in 99 and 2001, which corresponded with that double bottom we saw in the metals complex. In this case, there was even the little second, I didn't mention this before, but there was a little secondary high or preliminary high, I should say, in 2006, and then we went down and then up with the metals into that 2008 9-year cycle top. The CRB did the exact same thing, topped in July of 2008, and then crashed into February of 9. And the pattern has been the same. Like I said, the 9-year cycle top in gold, when was it? It was in 11. And all the other metals was sometime in 11. Well, the CRB, it peaked in 11, in May of 11. And now has crashed again, basically down into the January 2016 low. That was a 3-year cycle low. Well, the problem here is that we're seeing evidence that 3-year cycle may have already topped, or it certainly is at jeopardy of it. And to say it may be from a slightly different angle, it's certainly not encouraging that at this moment in time that it's going higher. So until it proves that, what this is also telling us is that the commodity complex, and again, put it all in context. We know the pattern is the same. The cyclical pattern is the same, and if this is telling us, the CRB complex itself is telling us that there is, something wrong. Something's not right. The relative strength is not there. The positive structure is not there, and we're seeing the same thing in the XAU and the HUI, and we know that historically there's been 9 of these cycles, then the risk is high with this breakout. And I understand the excitement. And maybe this time is different. I can even go there. I mean, maybe this time is different. Maybe we did see the 9-year cycle low in 15. Maybe. But we don't know that yet, and we're not going to know that until we get the evidence with the next little annual cycle down, which is due later this year. And if it bottoms above the 15 low, then okay, fine. We got it. Then we got proof, and that low is the buy point. But here's the other thing. Maybe, on the other hand, these statistics do hold. maybe the HUI is really warning us of something. Maybe the CRB is warning us of something. The warning that we're seeing is meaningful. And maybe there will be that 9th seasonal cycle down, and maybe gold crashes just like it did into all of these other 9-year cycle lows. So that is the risk with this breakout. And again, I understand the excitement. So we have to eliminate that risk before I feel comfortable being bullish on gold. And the only way to eliminate that is to see this next annual cycle down that is due later this year.
We'll have more with Tim Cyclesman Wood right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Tim Wood. Tim, is oil going to show the same kind of pattern, or does it work on a different cycle than all the metals?
It's very similar. It's very, very similar. And like I said, I realize that we've said that it's a counter-trend advance in oil, and still believe that, because of that pattern. And while it's held up, it hasn't invalidated the pattern. And so we have, like I said, we have this higher degree, intermediate degree cycle down in commodities, the entire commodity complex, toward the end of the year. And, it doesn't matter if we're looking at crude oil or tin or soybeans or whatever. We need to get that low and see, it's going to be one or the other. Either we're going to see the break as anticipated into lower lows, or we're not. If we do, then hey, guess what? The statistics are they're whole, they're 100%. We got the low and we know where we're at, and that's the buy spot. If we don't see that low violated, then guess what? Then we have evidence to prove that, okay, this time is the time that's different, but then we got the evidence with the wind at our back, if you will, with that evidence to buy that low. And then my argument would be the fact that we saw the 9-year cycle bottom early, the fact that we got the higher degree or the annual cycle low at a higher level, I would argue that's very bullish. But we got to get to that point, and there is an annual cycle down. And so I just don't want people to get too overly excited too soon and be crushed. I mean, imagine if you had bought gold in 2008 as it was ramping up into the top, going, oh, it broke out, and oil is going to, $200 a barrel, and it crashed. That's the risk here, and no one sees that. And so until, like I said, I don't mean it's like a broken record, but until we can prove structurally, cyclically, and with time that cycle is not going to, that this time is different, and we're not going to see that, that's the risk you face.
We'll have more with Tim Cyclesman Wood right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're still chatting with Tim Wood. Tim, if we're expecting a correction, we don't know how big, sometime this fall, how can people protect themselves?
Well, my thinking is just as far as metals, it's not time. So it's not a matter of protecting yourself. It's a matter of trying to be patient. You know, one of the things I walked away with from reading the old writings of Dow Theory founding fathers, I think it was Robert Ray that said it. He said the market takes the patience of a dozen men. Well, these days I think it takes the patience of 100 men. But you know, point being, patience. And you can't let another thought from the Dow Theory is you can't let the wish father the thought. And I realize that, you know, people can put that on each other's foot and point the finger, but you know, my point is we just don't have the structure to prove that this is real. And my other point is that, you know, people tend to want to believe what they want to believe. I try, as hard as it is, I try to base my opinion on statistics, structure, cycles, and so that it eliminates, if you go by the rules, then it eliminates your opinion. You know, at least it try to remove as much of the biases as you can by relying on the work. And sometimes that flies in the face of what may appear to be reality. And it's just like another example. Again, I don't care what somebody believes. If you think this is a breakout, then by all means jump in. But I'm just telling you the risk. And it reminds me, I may have told you this story before. It happened to me on 2 different occasions from 2 different people when gold crashed coming out of the 2008 high. 2 different subscribers called me, grown men, crying at the losses. And they said, I just couldn't believe it. I couldn't believe what you were saying. It wasn't what I'm saying. I'm just the messenger with the statistics. And so, like I said, I'm not denying that this time could be different. Maybe it is. And that's not a cop-out. It's not doublespeak. I'm simply telling you we have to eliminate the risk before we can have the probabilities behind our back. And the risk is a similar decline there. That said, looking at equities, this last research letter that I put out in September is one of the most important letters I put out in a long, long, long time. And not to sound like a salesman, but if anyone wants the details of what we face here, that is a good piece of research in that letter, tying commodities, equities, and the whole thing into one big ball of wax.
Tim, how can people get that letter?
Cyclesman.com and subscribe.
Do you find it interesting that places that you used to broadcast on, like all the business channels in the U.S., you were a regular guest, all of a sudden you were persona non grata? What happened there, and what's your theory?
Well, my theories is that there was an effort to silence the message. And, you know, I think that people don't want to hear what they don't want to hear, and I think maybe there's you know, something else at work there to silence an unpopular message. And I think it's that simple. And, you know, the one thing that, you know, I can pride myself in is that, you know, I'm going to tell it like I see it. And that said, hey, I'm the first one to admit that this bubble has gone on far longer than ever imaginable. You know, it is what it is. You know, we had our DNA markers set up in 2015. We got that weak decline. I say weak. It was one of the most, the mildest declines into a 4-year cycle low in equities in the history of equities. But you know, it is what it is. I can't control the market. And again, that's not a cop-out. I mean, it's just a fact. And then finally, the equities all throughout 16, they just kind of floundered around, and then they caught a bid again. And then we ramped up into this high, and we're still trying to make another top. And, you know, I'm not going to get off of the unpopular message that it's a bubble. I realize no one can see that, or not no one. I mean, there's some people who can see it for what it is, but the average person, I mean, it just feels like, you know, we talked about this before, some sort of a new norm. And you know, if you're in an environment of extremity long enough, then that extremity becomes the new norm, and it doesn't feel like it's abnormal. It's abnormal. And it was a bubble, you know, before, it's a bubble now, and if it goes up another month or 6 months, it's just a bigger bubble. And the inevitable is the same. The outcome is going to be the same. And our job, my job, is to identify the DNA markers again, the primary bearish trend change, and when all that falls in place, then the market is going to be at great risk of the bubble unraveling. And will it? I don't know. But when those things fall in place, like I've told people before, maybe said on here, it's like driving down the street to an intersection. When you get that set up, you're at that intersection and you have the opportunity to turn or go straight. And so what the market does with that, I don't know. Personally, I can't imagine once we get the setup in place that it doesn't, things don't turn and in a big way. And there is a relationship, like I said, with commodities, the metals, the dollar. By the way, the dollar should be making a major low here. Everybody's bearish on the dollar. They could be right, but we're in a window of time to where the dollar should be making a significant low. And if it doesn't take advantage of those cycle lows, in other words, if that opportunity is missed, then yes, the dollar's going to fail big, and then maybe that's what gold is seeing. Maybe then it all makes sense. You go, okay, well then it proves that we did have the low. But until that happens, like I said, I think the dollar is at a major low, commodities are at inflection points, and obviously I think equities are still blowing up into a bubble trying to make that top. And I think the inevitable outcome is the same. We just have to have the setup in place, which we do not have yet.
Tim, you've said on the past, there's no embarrassment taking cash at any time because it's the safe thing to do.
Well, of course, it is the safe thing to do. I had an old investor, tell me one time, he said, there's really three positions that he said he viewed three positions in the market. He said, I'm either aggressively long, aggressively short, or aggressively in cash. And there's, when there's the analogy that I use, and I know analogies that can be corny, but these warnings, like I said, it's kind of like, walking down the train track and seeing the train coming. It's not a tragedy that the train is coming. The tragedy is not getting off the tracks. And I realize that the train has been further down the track than we thought. But again, that's a horse of another color. We can't control that. We can't control the fact that, this thing has been successfully blown up into what I would argue the largest bubble in the history of the U.S. markets. It's still a bubble. And the cycles are still at play. The Dow theory is still relevant. The statistics are still relevant. And once we get the setup, I stand by the expected outcome, which is utter disaster.
Tim, thank you so much for chatting with us. And again, thankfully, the storms missed you.
The storms missed us, and hopefully, I hate that they hit anyone, but hopefully these storms will, we got one more out there, and hopefully it'll, be minimal damage or turn back out into the Atlantic, and maybe hurricane season will come to an end soon. But again, I want to say there is the September letter was a very, very important issue, and I urge people, and Jim, you have it. I know that you've been busy. You were telling me with some things, but I urge you and the staff at House Street, y'all please read that letter. That is an important issue.
Tim, thanks again.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views. You can find it and sign up if you like on cyclesman.com. You're listening to HowStreet.com radio. If you have any questions for our guests, you can email us at info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.